normally experiences when we start, we make certain decisions, and more likely they wrong or maybe not as expected, right? So over a period of time with
Hmm.
experience, we observe and we improve on decision making. But again,
Right.
I want to understand on the point, like when it comes to decision making, so the idea is to cut down on the decision point, or you think it other way around.
So what you have to think also is that you have to break it down in terms of, no, the question is not about do you reduce the number of decisions or increase, right? That's one way of coming about it. Is also to start off in a situation where the probabilities, at least to begin with, are favorable, right? Like often we say, right? So and that's, I think that's coming to the next part of this particular presentation also. I had already spoken about, right? The role of betting, right? At any point of time, what is it that you're trying to do, right? What you're trying to do is you're trying to make a positive EV decision. What does that mean? It's positive expected value decision. You're trying to evaluate what is the likelihood of making a profit, what is the amount of profit you will make, multiply that minus probability of making a loss into amount of loss which you will make. So at any point of time, you know that there is a possibility of making a loss, right? Like for example, the example which I gave, right? When you started off, you had a 55% probability of winning the pot and a 45% probability of losing the pot. You started with double ace, the best possible hand when the game started. And then somebody, some card came up on the community card and the probabilities dropped. So at that point of time, now you have to make a decision that if I and I won't get into the technicalities of the game, but at that point of time, you have to do a quick mental math. Okay, this is the size of the pot. This is the extra amount of money I am going to put. Am I still making a positive uh, expected value decision or not? And that is what you're doing as an investor also. What that means is, although it is a positive EV decision, so first of all, most of us, we will not sit down with a piece of paper and pen and start doing it math. But roughly speaking, you are doing that, right? Let's say a stock usually sells for 20 times earnings, right? Doing fairly okay and all of that. And something happens, right? The market starts running up, some good news starts coming in, and the stock is now selling, let's say, at 50 times earnings or 60 times earnings. For whatever reason. We saw that with a lot of these consumer good companies, right? At that point of time, what you have to think of is what is the upside which I have? Let's say a consumer good company, let's say a Marico or again, I'm just taking names. I don't hold it. This is just again for example purpose. Let's say a Marico is selling at 60 times, or maybe let's say 80 times earning. It is growing at 7% CAGR, right? Its usual, its average or its median PE ratio has been, let's say, 50 or 40. At that point of time, just think of it, right? What is the upside which you have? The upside which you have is, the valuation should keep rising from 70 to whatever, 80 to 100. How many companies can support a PE of 100 on a 8% earnings growth? How do you calculate that? Look around, right? Look around globally, how many such companies are there? I would say it's, you will find less than 5%, even lesser than that, companies which can support it. So at that point of time, you know that if you multiply the gain which is possible into the probability of gain minus the probability of loss into the loss, right? Again, you will not sit down with a pen and a piece of paper and say, I will lose minus 16.3%. But roughly speaking, you are getting an idea, right? You are moving to the realm where the probability, the gain which you can make, which is that a company is growing 7%. So let's say you take a 3-year view, right? How much is the earnings growth you can get total? 20%, right? What is the probability of making of a gain? 10% at best, right? What's the probability of loss? The probability of loss is definitely more than 50%, right? Because you know that the company is overvalued, no other company sells like that. And then what is the amount of loss? Simple math, you can do, take the median earnings ratio, right? PE ratio 50 into what is the earnings 3 years from now. And if you actually do it, you'll get a fairly decent mathematical number on it. If nothing else, you'll get a good idea that this is a negative EV decision, right? Versus flip that around, right? Let's say you are working with a company, the company, which is what, think of it, right? Which is what happened with the whole, which is what happens when a sector suddenly picks up, right? Not doing well for a long time. Its P ratio is below its, its long-term average. Earnings have been, below trend. So what is happening in this case? Your EV is becoming more and more positive because the downside is getting limited, right? The stock is, let's say, selling at a 10-year low, right? Its earnings, its PE ratio is way below median, right? So the downside has gone down. Whereas any good news comes in, the earnings will start increasing. The probability is anyway high, right? Because you know that the downside probability is limited. It's a positive EV decision. That is what investors do, right? They see the stock is very cheap. It's very likely that they don't know the exact timing, but maybe 6 months, 9 months, 12 months from now, the winds will change, right? And they will start making. So it's a positive EV decision. What do traders or technical analysts or traders do, right? They're looking at charts, but that's what they're doing, right? When they talk of a pivot point, when they talk of a of you know of picking that precise point, what they've done is they're looking at the chart and they're saying my downside is limited to 5% or 7%, right? And they have also put a stop loss in place. What is the upside? They look at the chart, they calculate that. Even if they say that there's a 50-50 chance, what they have done is they've ensured that the gain is more than the loss. And if the if the probabilities are 50-50, which is usually not the case, that is where the edge or the setup comes in, right? They know that a particular chart pattern means that the odds are in their favor, right? Which means the probability is in their favor. And then they are further improving their EV by keeping the loss lower than the gain. So let me stop here. I think this is an important point, and if anybody has a question, we can talk about it, right? The point is, how we're trying to calculate it. And both actually traders and investors do the same thing. Just their time frames are different, and the parameters they use are different. And so a lot of times people end up talking past each other. This is good, bad, that is good, this is bad, that is bad. But I mean, think of it a little more deeply, right? We are all doing exactly the same thing. We're all making a positive EV decision. Only the factors we use to make that decision and the time frames we use to make that decision are different. So let's stop here, Prince. Let's